I am Maddie Napier, the principal, founder, and financial planner with Minerva Wealth Planning, a fee-only firm based out of Columbus, Ohio. Today, we're going to have a Minerva Money on real estate, investment real estate, and things to consider if you are already in that space or planning to get in that space when it comes to your return on investment, or ROI. So I often get the question of whether somebody should go into investment real estate, if they're already in investment real estate, how they should be measuring their success with that investment property, whatever type of property that may be. And I think people kind of think about it a little bit too simplistically. They, what their mortgage costs, right? So they purchase this property, what is their mortgage cost? And then they think about what they can get in terms of rent from tenants. And while certainly that's an element of determining what your return on that investment is, being that you will be getting cash flow throughout the year. So, what does that look like in terms of what you're spending on the property versus what you're making? But I think there are often some things that are not considered, other expenses, for example, that are not included in that ROI calculation. And this is where a lot of people don't see the results they're hoping for or that they're expecting. They think that just by investing that they're going to automatically make a great return because they're only looking at those two figures, their mortgage and their income from tenants. So some of the things that people don't quite think about that they should be thinking about are, maintenance throughout the year. So little fixes, little things that need to be done throughout the year, depending on the age of the property. Large expenditures, such as, purchasing new HVAC systems, purchasing new AC systems, those large expenses that you need to save over a period of time for. Vacancy, and that can be anywhere from 5 to 15% depending on your location. So certainly want to consider that in your calculation as well. Some of the things like snow removal, lawn care, little expenses throughout the year that can certainly eat away at that return. If you have a property management company, that they're certainly going to take a percentage or a fee on the amount that you'd be making from the property. Taxes, and then of course your mortgage and potentially a homeowners association or some type of association. So really important as you're calculating your return on investment that you consider all applicable expenses, not just the mortgage, and compare that to what your tenants are paying you when calculating your return on investment.